Hello, I am your host, Mike Gelb, and welcome to the Consumer VC, where we're going to be dive into the world of venture capital and consumer-facing startups. Our guest today is Jordan Knopf, managing partner and the head of investments at Tusk Venture Partners. Jordan has led many of the fund's capital investments, including Lemonade, Bird, Alma, and Sunday. He currently serves on the board of directors of Alma and Sunday. Prior to Tusk Venture Partners, Jordan spent 6 years as a director at Blackstone, where he focused on the development of the firm's corporate venture capital portfolio. I had a great time chatting with Jordan and learned a ton. So without further ado, here's Jordan. Well, Jordan, thank you so much for taking the time and coming on the show. How are you today?
Great. Thanks for having me.
So, Jordan, what made you leave Blackstone in order to go into venture capital and join Tusk?
Yeah, I think that really at its core, it's something, I really wanted to build something for myself, the sense I wanted to become an entrepreneur, and I wanted to create an environment where early stage investing is really ingrained in the DNA of the firm. Throughout my time at Blackstone, I was able to learn a lot, and it's a tremendous firm. They're definitely masters at their craft of in the private investing space, on the leverage buyout end. However, it's really difficult to shift the focus of a firm, and I knew that early stage investing would really never be what is in the limelight for Blackstone. And so it just made sense for me to go out and set up my own shingle with my partner now and start our own fund.
I love the entrepreneurial spirit. Tell me a little bit about Tusk, your thesis.
Yeah, so as far as it goes with kind of our thesis and where we look to invest. So typically what we're doing is we're an early stage venture fund. So really our focus is on investing in startups that are operating in highly regulated markets or creating new verticals altogether where there is no regulatory framework that exists today. Typically that looks post product. So let's say institutional seed or Series A is really our sweet spot. We typically do more consumer than enterprise, and typically it's in North America. The reason for consumer versus enterprise is that given the focus on the regulatory, political, and media side, regulations exist to protect consumers, not businesses. So that's where naturally we have the greatest impact on the investments that we make. From a stage perspective, as I mentioned, earlier stage is better for us on the from a point of entry, but we try to be able to add value throughout the course of the life cycle of every startup that we invest in.
What about investing in startups or verticals that are in regulated industries? Why does that excite you, and what is the Tusk advantage?
The notion whenever we created Tusk Venture Partners was that in order to be successful as a venture firm over the long run, you do need to create a differentiated product or offering that you're providing entrepreneurs. And so what I found in my partner, Bradley, was kind of marrying the venture capital investor, generalist hat with somebody with a deep expertise with navigating complex political, regulatory, and media related issues. And the ultimate thesis that we had was that companies that are, emerging in creating new verticals altogether, eventually, if they become relevant and successful, they'll end up facing regulatory hurdles. Just in the spirit of regulation always lagging innovation. And if we're the only fund that sits at the nexus of technology, politics, and regulation, we can make a fantastic partner for these early stage companies. And it just makes our dollars greener than the next fund that's only offering generalist services to their portfolio companies.
One of your focuses on startups that maybe are creating new verticals altogether. How do you think about TAM and the size of the actual market for these types of startups where, a vertical doesn't exist yet?
So how do we think about it is typically we spend a lot of time analyzing what we think the market looks like today and some relevant comps from that. But ultimately, if we think that market size could change, it's almost always wrong. I'm going to go ahead and say that right off the bat. I think a great example of that is a early stage investment that we made not too long ago, but they've been a very fast growing company is Bird. So we invested in Bird at the Series A. There were 68 scooters that were operational at the time. There were 5 people working out of a WeWork in Santa Monica. And thinking about the TAM, you draw the analogy of, okay, we understand how large the bike sharing docked market is, but what happens whenever you remove the docks and you remove the friction that's associated with some of the bike sharing problems that you've seen in New York and other major markets, and introduce a concept that is just it's not something that it's not a brand new technology. It's just the right time for it to be introduced to the market. You have proxies for ride sharing as well. So really, you need to assess kind of where you think that is today, and what the company looks like if they can take a meaningful market share without growing the market, and then revisit it from the context of what does the world look like 5 years from now, if this actually takes off. So the leap that you needed to make to invest in Bird at the Series A was, are people going to be willing to take scooters as a primary method of transportation to and from work? That was the leap that you needed to make, because we knew that the trips were 1 to 3 miles, the same length as an Uber ride. So the total addressable market was, whenever we go back and reflect on our memo that we wrote about the investment, we got a lot of things wrong, but I think that underestimating the market size, luckily we ended up getting to a yes, but underestimating the market was significant.
What makes you excited about investing in consumer companies in today's landscape?
That's a really great question. I think that at the end of the day, consumer, I'm excited about consumer because that's where we, our competitive advantage is, more applicable on the consumer side than on the enterprise. And also just in terms of investing in consumer versus enterprise in general, those are typically, if you happen to find a company that does enter hypergrowth, you don't really see companies just go through that transformation as quickly as you do on the enterprise side as you can for consumer. So, companies can't be built and attract, and this is a function solely of sales cycles. So you're not going to see companies that can attract hundreds of thousands of users over the course of a few months on the enterprise end. It's just it's a slower cycle, but it's something that can be really exciting.
What are some consumer verticals that you're most excited about currently? I know that you mentioned Bird and transportation, but what are other verticals that you're excited about that you think are ripe for disruption?
In terms of broader landscape, just verticals that are core to our DNA and our logical extensions and are reflected in our portfolio already. Transportation, as you mentioned, fintech overall. So that includes everything from insurance technology, real estate technology, all wrapped up under one big asset class, big vertical. I think that also, whenever you look at digital health and the transformation that's happening there, that's something that we're really excited about. And obviously, the common thread here is the level of regulation that exists today, and the amount of opportunity that's there to create products that are at least 10 times better than the current product that's in market. So, for a long time, venture funds were shied away from investing in highly regulated markets because it's a very difficult risk to assess. And I think that's one of the core competencies of our firm is that we have those insights and can properly evaluate those additional risks.
When should a company have their product market fit when it comes to consumer?
So, and everybody has an opinion on it, and it's something that these are kind of guardrails that I like to think about to help make informed, systematic, decisions, and to look back at your portfolio and see if you were right or not, and help that inform future decisions. It's interesting though, because, the initial notion is that you really want some form of traction, meaningful traction or product market fit to be demonstrated at or about at the Series A. That can take different forms. That doesn't necessarily need to be tied to a revenue number. I know that some firms want to see, traction defined by a certain amount of ARR or a certain run rate revenue at the Series A, whether that's, somewhere between $2 to $5 million. However, if I take that framework and apply that to our portfolio, we would have passed on some of the fastest growing companies in our first fund. So that we would have missed out on both Bird and Lemonade.
Wow. What are some of the metrics that you use in order to measure if a company has product market fit?
There's not really one answer to that. Sometimes there's some quick screens that you can do, but I think that really, if it's a consumer company, you're going to look at everything from if it's, it really matters what type of product you're describing. And I'll give you examples where you can kind of piece together product market fit based on demand from an enterprise and a problem that needs to be solved. So, for example, if you're looking at a digital health platform that's trying to provide addiction rehabilitation treatment using medication-assisted therapy for the opioid epidemic, the problem exists, right? There's a huge market for it. And if you have an insurance company saying that they want to utilize this platform as the sole solution to their underlying companies that rely on their healthcare, that's a pretty good proxy for product market fit. On the enterprise side, talking to the CTOs of large companies that are using the product and why they like it, and they're willing to be vocal about it, is one way to do it. On the consumer end, it's a little bit harder because consumers are somewhat fickle. But I do believe that the real product market fit is whenever you find a customer that is staying engaged with a platform or with a product, and that consumer base is growing. Either they're increasing their average order value, they're increasing their level of engagement. That's a real core component. I do think that not every consumer is considered equal. So I try not to rely too heavily on just number of downloads or initial orders that come through the door. But I think it's much more of leveraging several data points to come up with a much more informed decision.
I had one investor that says, in terms of product market fit for a consumer, you kind of know it when you see it.
No, and I agree with that. It's definitely, it shouldn't be limited to product market fit, should not just be limited to one company. It's something that if you were to go back to the Bird example, you can get, it was very apparent that product market fit was there based on the retention numbers. I think that's something that's really important. And that's how something really goes viral on the consumer end, is if very strong growth rate continues for a prolonged period of time and no one's churning off the platform. But then in addition to that, you're going to see a bunch of new market entrants come into the fold. And that's kind of codifies your assessment that there is market fit, because you start to see a lot of new players enter.
What are some qualities that you, if you maybe have a checklist or must-haves that founders must possess, or at least that you like to see founders possess?
With regards to just founders, or with regards to just kind of the kind of core screening aspect of anybody coming in to pitch our partnership, I think that primary focus is, a lot of it is going to be on the team. So the founder is that's where we're really trying to evaluate the execution risk that's associated with the deal. I think that if it's a big market that they're going after, that's great. But really kind of the core value that we're looking to assess in a founder is this the right team to go after this large market? Because my opportunity cost of investing in that idea is that I can't invest in a potentially stronger team that's going to come pitch me the same idea several months from now. And so I think that the focus on founders that exhibit specific traits, that's a great question. And it's one that, if it boils down to it, what have they overcome to get to this point, and what's their ability to overcome obstacles in the future at its core? So the grit and the tenacity to get in front of a venture fund to pitch an idea, it takes a lot of work. You got to get a warm introduction, and if some people that come to that basically launch a company without some of the advantages of having a deep network of people, if they didn't go to school at Harvard or at Stanford, they have to jump through a lot more hoops. People that have, unfortunately, I feel like there's a lot more hoops that women need to jump through, or minorities than other people, just to get in front of a venture fund. We try and consider all those things, because those are trailing indicators that show how somebody can overcome obstacles that will definitely occur throughout the course of a business life cycle.
Those are all excellent examples. How do you think about the future of regulation in maybe certain industries or verticals?
This is something where we leverage the political and the regulatory side of our firm. My team consists on the fund side. We're investment professionals that we're lucky enough to have access to a significant number of political, regulatory, and media specialists. So I think that we're always looking for informed views on potential changes to regulation that could open up new avenues to apply technology and solve very large problems. A good example here is in healthcare right now with digital health. Our view on the regulatory landscape, I guess, on telemedicine specifically, is that we're going to continue to see loosening regulations around that, and that obviously expands the reach and increases the application of technology to kind of a bunch of different aspects of the healthcare ecosystem. So that's a part of our lens into evaluating each company. It's something that a lot of times focus of a founder is to mitigate a regulatory risk that we don't think is as important as they view it as, but also kind of informing them about risks that they need to be aware of as they grow.
How do you think about good growth versus bad growth in this current era?
This is something that specifically on the consumer side has changed a lot over the last few years specifically. One thing that definitely should be mentioned is the fact that on the consumer product end, the notion of the way to acquire customers has changed. So, digital spend that you used to be able to put into Google, AdWords have somewhat less value now, just given the fact that Amazon search really is where 50% plus of consumer searches begin. So it's not starting on Google, it's actually starting within Amazon. And there's no keyword optimization that you can really do to market effectively on Amazon. But with that being said, we do think that good growth and versus bad growth, a lot of that comes down to churn and kind of acquiring customers, retaining customers at a price point that's sustainable and competitive, where you're really getting high quality consumers onto the platform. That means that they kind of have high intent to purchase and the product, stay on the platform, and really kind of increase the LTV to CAC ratio. That's a pretty important metric for us.
On your point about Amazon, do you think that Nike announcing that they're no longer selling on Amazon, do you think that's a big deal for D2C brands?
It makes all the sense in the world for new companies to launch using a direct-to-consumer platform to prove out what we were talking about earlier, right? To prove out that the market wants what they're selling. It gives you immediate reach, and it gives you access to what is now a growing population of people that prefer to purchase, or at least research items online. And so I think that to get up and running using a direct-to-consumer model makes a lot of sense. Now, to stay with just a pure direct-to-consumer model does require a little bit more, more of a use case around providing customized products that cannot be sold just in bulk on Amazon or in a traditional retail store. So to the extent that you're providing consumers with a bespoke solution, whether that is a slightly refined product or something that's curated specifically for them, is really a perfect application for the D2C distribution channel.
What is something that you would change when it came to venture capital?
I think that this industry is under it's undergoing a tremendous shift right now to begin with. We've seen this with kind of the old school marquee firms that have been household names for the Valley for a long period of time. They've raised very large funds, and that's a shift that's happened in the landscape, right? So the people that used to be investing $100 million funds into traditional Series A's now are managing much larger pools of capital. We've also seen a tremendous institutionalization of the pre-seed and seed round. And so there's just a lot more access points for capital, which is a good change because that requires people to add additional value to founders to be that preferred choice. So that increased competition is healthy. However, it would be great to get some more diversity in terms of partnerships that are out there today. So, increased number of women that work in venture, in addition to underrepresented minorities that don't make up the bulk of people on the entrepreneur side or on the venture capital investor end.
Yeah, I mean, I very much agree to all those sentiments. What's one of your favorite books that has impacted you personally and one that has impacted you professionally?
I think that they're somewhat tied together. It's kind of hard to identify one book that, from a personal perspective, I hope that all books kind of impact me to some degree on a personal level. And then, a lot of times reading books, the worlds kind of merge together. I think that 0 to 1 is probably one of the better books that can concisely paint the picture of one of the best investors that's out there and their contrarian view on the world and how that makes sense. So on the personal level, there's takeaways that are very impactful, like always challenging the status quo. And if you find yourself asking why over and over and over again, you're probably onto something. I think that's applicable in business and in your personal life. And it's just one that, I think that there's some lessons there that it means something different to every reader, but it's definitely a book that I encourage everyone to pick up and read through.
I love that, asking why over again. What is your most recent investment and why are you excited about it?
One of our most recent investments is a company called Sunday. It's a company that there's a lot for us to love about it. It's a direct-to-consumer company. They're based out of Boulder, Colorado, that launched last April. And what they're doing is providing non-toxic, all organic, basically trusted product for everything exterior home. So this is launching on the foothills of a very contentious Monsanto lawsuit with regards to Roundup, and it's linked to causing cancer. And so the right time to launch a product that, is something that's environmentally friendly, that's something that is a core value to consumers right now, something that's a core value to, I would say, millennials and to Gen Z buyers. And that's a shift. So it's kind of the perfect storm of several shifts that we're seeing in the market. So what Sunday is doing is they initially launched with a non-toxic, essentially fertilizer, so lawn care, which is a very broken industry from the beginning. It's something that, hasn't changed in decades. And it's essentially you're putting poison on your lawn. There's very few options for which type of poison you want to use. And turns out you actually don't need to put poison on your lawn. That the efficacy of the product actually has to do with the timing, not the chemicals that are involved. So it's a perfect application of a direct-to-consumer brand because at the end of the day, going to Home Depot or Lowe's, there's no brand affinity that exists with Scotts or Bayer or any of these chemical companies. But that's where the opportunity lies, is to create a brand to really capture to be the trusted platform for consumers. So millennials are on average 33 years old right now. The average first-time home buyer is 34. So in the next year, you expect that the first-time home buyers, which is the target demographic for Sunday, to really hit an all-time high. And it's something that, this is the right time to launch a product in this space. And it's something that, we think it's a great narrative that's resonating a lot with consumers. And so we're really excited about what the team over there is building and, really excited about their future growth.
I really, really like the fact that you brought up how important timing is.
Yeah, absolutely. I think that, timing plays a major role in a lot of companies' successes or failures in regards to there's a lot of analogies, that get surfaced all the time about companies that try to introduce a product and the timing just wasn't right. And then it gets reintroduced 10 years later and it works tremendously well. And I think that has to do with kind of the market, that target demographic, and kind of what their core values are. If it may have not resonated with the generations before. And so that's something that's really important to try and understand, because that's going to be an ultimate driver. And a perfect example of that is we saw this shift take place where over the last few years, people moved from, they want to be affiliated with brands that are rooted in the same values that they hold, but they would pay a premium for something that was organic or non-toxic or something that was environmentally friendly. To now, where it's so important to them, they're not buying products from brands that don't align with their values. So we're seeing this from big box retail all the way down to direct to consumer brands, that they don't want to be associated with selling products in. So if you look at some large big box stores, they'll be pulling products off the shelf that don't align with their values. And the same happens with the way that consumer purchasing unfolds.
Yeah, no, I agree. What's one piece of advice that you have for founders of consumer companies?
So I think that you can't really underestimate the value of having some form of domain expertise and a very strong reason for why you quit doing what you were doing before to start this company. We're starting to see in consumer and in the ecosystem in general, you have a lot of founders that are kind of looking and trying to come up with ideas to solve problems that weren't just presented to them as such a large issue that they have to quit their job to start this company. It was kind of always in the cards that they wanted to start a company and they're just looking for the right idea. That is, I think that you have to have a genuine level of curiosity and a real drive and passion to do whatever it takes to kind of solve this issue that's so painful that you're willing to give up everything that you have to build something from scratch and overcome obstacles where the cards are definitely not stacked in your favor to do that. So I think that level of genuine kind of curiosity and ambition comes off very quickly in pitches. The advice that I would give is just, people come in and be themselves and not to read too much into why a venture fund decides that they want to pursue that opportunity further or not. That's something that really I cannot stress enough.
We've talked in previous episodes about that founder market fit. Why are you the person that's going to solve it? What's your actual own advantage? Well, Jordan, this has been an absolute pleasure. Thank you so much for coming on the show and taking the time.
Couldn't agree with you more.
And there you have it. It was such a pleasure having Jordan on. I hope you all enjoyed that as much as I did. You can follow Jordan at Jordan Knopf on Twitter. It'll also be located in the show notes. If you'd like to follow along behind the scenes of the show, you can follow me at Mike Gelb and at Consumer VC. For all episodes, please visit theconsumervc.com. If you're enjoying these episodes, if you could please leave a review on the Apple Podcast app, as that increases the exposure of the podcast, that would be simply terrific. Until next time, folks.